Hey everyone, welcome to today's exclusive webinar brought to you by Vantage. We're gonna do the consumer economy, how spending drives everything. Okay, how it actually moves the economy, moves the market, and basically helps your currency grow as well. Okay, so before we start, I just want to find out, just let me know in the chat box really quickly, how's everyone doing? Where are you tuning in from today? Drop your country and city in the chat. It When you talk to me in the chat box, it also helps me know that my audio is still working and that the chat box is working. So do talk to me throughout the webinar so that I know that I'm not talking to myself because there has ever been an incident where I was talking for like a good 10 minutes before I finally realized that my mic wasn't even on. Okay. Hi. Hi. So I always love seeing how global our trading community is, and we usually have traders joining in from, I've got someone saying Malaysia, South Africa, Mexico, Indonesia, Australia, Vietnam, Europe, Middle East. Okay, so hi. Let's try to make this interactive, okay? Okay, cool. So today is the 30th of December. This is the last webinar I'm going to hold for you guys this year, and then I will see you guys next year. Yeah, let's get into it, okay? Oh, sorry, before we actually begin, I'm sure you guys know how this works. I do need to do the disclaimer. It's very, very important. Okay. This webinar is for educational purposes only. Just a reminder, everything I share will be based on my own analysis, my own observation, and my own experiences as a trader and an analyst. Okay. This is not a signal service, any form of financial advice, investment advice, or any form of signal to buy or sell. Okay, the goal here is to help you understand why the markets move the way they do and how to apply that understanding to your own trading, especially if you're trading with Vantage. Okay, so trading involves risk, especially when dealing with volatile assets like oil, which we'll be talking about later on. Okay, so please make sure you trade responsibly, manage your exposure wisely, and use today's insight as part of your own informed decision making. Okay, I will have to stay here for a minute or two so you guys can read through the disclaimer. But yeah. Okay, I think that should be a minute or two already, and I'm sure everyone would have read through the disclaimer. It's not that long anyways, but yeah, the whole point is to tell you guys that this webinar is educational for educational purposes only and nothing else. Okay, so let's do an introduction of your host, which is me. My name is Cassandra. You guys can call me Cass. I am an investment analyst. I'm based in Singapore. Um, I am with Everest Fortune Group, which is a research firm that has been recognized as the finalist for the best Forex and the best equity research for multiple years running. So we are very versed with the markets. We spend a lot of time forecasting, backtesting, researching, understanding every movement of every pair. So it can be commodity, it can be gold, it can be oil, it can be cryptocurrency, it can be stocks, whatever it is. That's our job to understand it and to kind of familiarize ourselves with it so that we can help you guys understand the markets better. Okay. On top of that, I am a prop trader. How did I become a prop trader? What is prop trading? Anyways, it means that I'm funded by multiple companies to trade their funds. How did I get this funding? I did 10% profit within a month, many times actually. How did I do that? I combined technical analysis with fundamental analysis. So back then, I didn't combine a lot of fundamental analysis, but nowadays I do combine a lot of fundamental analysis, just like our topic for today, which is a lot about the economy and whatnot. I combine that now and I find that my trades have become even higher probability than they were before. Okay, so if you guys have any questions throughout the webinar, ask me in the chat box. I'll try my best to answer you to the best of my ability. Okay, and yeah. Okay, so let's start with the agenda. So our agenda for today is consumer confidence and retail sales as market signals, inflations versus wage growth, and who wins, how spending data moves US dollar, equities, and oil, and what to watch during earnings and data season. Okay, so the other thing, I am actually very interested. I'm happy to share today's topic with you guys. Actually, when I saw that I was going to share this topic, I was like, oh, okay, I'm really excited to be doing deep research into this because I mean, it is important to know why spending drives everything, right? Because I don't know where you guys, a lot of you are from because only some of you answer me, but I'm in Asia and like a lot of times people don't want to spend, they want to save money and whatnot, right? But it's actually not really helping the economy grow when you're not spending. So let's understand how that works a little bit by going into today's topic. Okay, so, oh, sorry, I didn't realize. Anyways, it's consumer confidence. Let's start with consumer confidence and retail sales as market signals. Okay, sorry about this color thing, I think. Yeah, anyways. Okay, so let's understand why the consumer is the real engine of the economy. So when we talk about the economy, people often jump straight to inflation, interest rates, or central banks. But if you stripped everything back to its core, the real engine of the economy is the consumer. In most developed economies, consumer spending makes up roughly two-thirds of GDP. That means what households decide to do with their money, whether they spend it, save it, or delay purchases, ultimately determines growth, corporate earnings, employment, and even government tax revenue. Okay, so let me repeat that. In most developed economies, consumer spending makes up roughly two-thirds of GDP. So 66% of GDP still is up to you guys, up to me, up to you guys. If we are spending, we are contributing to the GDP. Okay, 66%. The other 34%, 33% is other stuff. Okay, so this is why markets care so deeply about consumer behavior. Even if it doesn't always feel exciting, the consumer doesn't react instantly to policy changes. Instead, confidence shifts first, behavior changes second, and hard data confirms it later. So by the time GDP prints reflects a slowdown, markets have usually already moved. Okay. So think of consumer confidence as a leading psychological indicator. When people feel secure about jobs, income, and future prospects, they spend more freely. When uncertainty rises, even before layoffs or recessions happen, spending slows. Markets watch this transition very closely because spending momentum tends to persist. A confident consumer doesn't stop spending overnight, and a cautious consumer doesn't suddenly splurge because rates fell 25 basis points, for example. Okay, so for traders, this matters because consumer data often explains why markets move in ways that don't seem to line up with inflation or rates. You might see equities holding up despite high rates or US dollar staying strong even as inflation cools. So often the missing link is the consumer. If spending remains resilient, growth holds up, earnings stay supported, and risk assets get a cushion. So before we talk about trading setups, we need to internalize one thing. You need to follow the consumer and you'll understand the economy far earlier than headline data allows. Okay, so yeah, so I've got this little circular flow diagram. Okay, so if you are a household and you're spending, it goes to the firms, but the firm's incomes, you also get it back to your household by working. Okay, if you're just spending and not working, obviously it's not a full cycle moment, but yeah, you need to spend, it goes to the firms, and then you get it back in income. Okay, it's the same. You you spend, it goes to the firms, and then you get the goods into your household. Okay, or you spend, it goes to the firm, okay, and you get it back one way or the other. Okay, that's why spending is crucial. I'm not saying you should go out and spend all you want right now. I'm saying a portion of your portfolio, a portion of the money that you have should be put into spending. Okay, so that you support the economy, right? Okay, let's move on with consumer confidence versus retail sales. The sentiment versus reality. So there are two major ways markets track the consumer: confidence survey and actual spending data. Consumer confidence surveys measure how people feel about their financial situation, job security, and the economic outlook. Retail sales measure what people actually do with their money. Both are important, but they serve very different purposes. Confidence tends to move first. It's emotional, psychological, and forward-looking. When confidence starts falling, it doesn't mean spending collapses immediately, but it often signals that consumers are becoming cautious. Retail sales, on the other hand, are backward-looking. They confirm whether caution has turned into action. So the most powerful signals come from divergences. If confidence is falling but retail sales remain strong, markets may stay supported in the short term but start pricing future slowdown risk. If confidence improves and retail sales follow, that's a strong signal of sustained growth. If both fall together, markets tend to react aggressively because it suggests momentum is breaking. This is where many traders get caught off guard. They wait for retail sales to weaken before adjusting their bias, but markets often move earlier based on confidence trends. That's why equity indices sometimes roll over before earnings deteriorate, or why the US dollar weakens before growth data actually turns negative. So instead of treating consumer data as noise, right, traders should treat it as a narrative builder. Confidence tell you what might happen. Retail sales tell you whether it's happening. When those two align, markets move with conviction. When they diverge, volatility increases. Okay, so I put a little graph here, okay, of consumer confidence which strongly correlates with spending. The high income current buying condition index currently most closely tracks changes in consumer spending and retail sales during pandemic. So this turquoise color is the index of consumer sentiment. High income current buying condition index, which is the dark blue. The yellow, the mustard color is real personal consumption expenditure and real retail sales. So you can see how it correlates a lot with spending. Okay, it moves quite closely to one another. Okay, so let's move on with how markets translate consumer signals into price action. Once consumer confidence and spending data are released, markets immediately start translating that information into expectations about growth, policy, and earnings. Strong consumer data usually supports equities because it suggests stable revenues and resilient demand. It can also support yields if market believe growth will stay strong and rate cuts can be delayed. At the same time, strong consumer data doesn't always weaken the US dollar. If resilient spending keeps yields elevated relative to other economies, the dollar can actually stay firm. This is why traders sometimes get confused. They expect good data to weaken the US dollar, but the rate differential story dominates. On the flip side, weakening confidence often increases demand for defensive assets. The US dollar can strengthen due to safe haven demand. Equities may soften on growth concerns, and markets start pricing future easing. But again, this doesn't happen off one data point. Markets look for patterns. A single weak retail sales number can be ignored. A trend of slowing confidence followed by soft spending is much harder to ignore or dismiss. Okay, so for traders, the takeaway is this. Consumer data, okay, is not about predicting the next tick. It's about understanding regime shifts. Are we in a resilient consumer regime where dips get bought, or are we entering a cautious consumer regime where rallies fade? Once you can answer that, you trade selection across Forex, equities, and commodities become much, much clearer. Okay, let's go into inflation versus wage growth. Who will actually win? Sorry. Okay, so the real battle here is actually prices rising versus paychecks um rising. Okay. When we talk about inflation, the conversion often stops at prices going up. Food, rent, fuel, services, but inflation on its own doesn't tell the full story. What actually matters to the economy, to markets, to especially to the consumer, is whether wages are keeping up. This is why the real battle isn't inflation versus zero, it's inflation versus wage growth. It's okay for prices to keep going up as long as my income is also going up, right? So if prices are rising at 4%, but wages are rising at 5%, consumers may complain, but their purchasing power is actually still improving. They can still spend, service debt, support growth, but if inflation runs at 4% and wages only grow at 2%, households are quietly losing ground every month. That's when spending slows, confidence drops, and economic momentum fades. Even if headline inflation looks manageable, people are ultimately not doing well if the wages are not falling up. So markets care deeply about this relationship because it determines whether consumption is sustainable or fragile. Strong wage growth can cushion high rates and high prices for longer than most people expect. Weak wage growth, on the other hand, turns even moderate inflation into a growth problem. So when traders ask, is inflation good or bad for markets? The more accurate question is, are wages winning or losing the race? Because the race determines whether consumers keep spending or start pulling back. And since consumer spending drives earnings, employment, and tax revenues, this dynamic sits right at the center of the macro picture. Okay, so why central banks care about wages more than prices? Here's a critical insight that separates surface level macro commentary from deeper understanding. Central banks are often more worried about wages than inflation itself. Okay. Yes, inflation is also scary, but keeping up with inflation is important. Okay, so prices can spike due to energy shocks, supply chain issues, or maybe even just temporary disruptions. But wages, once they rise, are very hard to bring back down. Wages feed directly into services inflation. Okay, think about healthcare, education, hospitality, childcare, transport. These sectors are labor intensive. When wages rise in these areas, prices don't fall easily, even if goods inflation cools. That's why central banks keep emphasizing services inflation and labor market tightness. They're looking for signs that wage growth is slowing to a pace consistent with their inflation targets. This is also why central banks often sound hawkish, even when headline CPI is falling. If wage growth remains strong, policymakers worry that inflation will re-accelerate once growth stabilizes. Okay, so cutting rates too early risk uh, recognition demand while wages are still elevated. That's the classic wage price spiral scenario central banks fear the most. For traders, like this explains a lot of confusing price action. You might see CPI cooling, but the Fed, ECB, or BOE refuses to cut. Markets get very frustrated. Yields stay high, risk assets struggle. The missing piece is wages. Until wage growth slows convincingly, central banks remain cautious. So when analyzing inflation, always look beyond the headline. Ask what are wages doing? Because wages are the glue that turns temporary inflation into persistent inflation, and central bank knows it. Okay, so let's look at market implications when wages support growth and when they kill it. The relationship between wages and markets is nuanced. This is where traders need to avoid black and white thinking. Wage growth is not inherently bullish or bearish. It depends on context. Moderate wage growth that outpaces inflation is actually very healthy. It supports consumer spending, stabilizes demand, and allows economies to absorb higher interest rates. In this environment, equities can perform well. Credit stays contained, and the US dollar may remain firm due to resilient growth. This is often what markets call as a soft landing scenario. But when wage growth becomes too strong, especially relative to productivity, it creates problems. Okay. Central banks feel forced to keep rates higher for longer. Financial conditions stay tight and valuation pressure builds in equities. Over time, this slows hiring, reduces profit margins, and eventually feeds back into weaker growth. Ironically, wages that rise too fast can end up hurting workers later through job losses and reduced hours. On the flip side, weak wage growth is a red flag. If inflation is falling but wages are also stagnating, um, consumption weakens sharply. This is where markets start pricing recession risk. Equities struggle, yields fall, and central banks eventually pivot. But often after damage has already been done. So for traders, wage data is not just another economic release, it's a regime indicator. Strong but cooling wages support risk assets. Too hot wages delay easing. Weak wages signal downturn risk. Understanding where we are in the spectrum helps you position across Forex, equities, and commodities with much more confidence and far less guesswork. Okay, guys, can you guys give me a minute? I'm gonna come back in like a minute or two. I just need to grab water. Oh, wait, actually, I still have water. Okay, I'm good. Okay, let's understand how spending data moves the US dollar, equities, and oil. Um, why spending data sits at the center of all asset classes? Let's find out. So when spending data comes out, retail sales, personal consumption, card spending, or services demand, markets don't treat it as just another economic report. Spending data sits right at the intersection of growth, policy, and earnings, which is why it has the power to move currencies, equities, and commodities all at once. At its core, spending tells markets whether demand is holding up or cracking. If consumers keep spending, companies can maintain revenues, employment stays firm, governments collect taxes, and growth remains resilient. That resilience feeds directly into how central banks think about rates and how investors think about risk. But here's the key. Each asset class listens to spending data differently. Forex focuses on what spending means for relative growth and interest rate differentials. Equities focus on what spending means for corporate earnings and margins. Oil focuses on what spending means for real world demand, for example, transport, travel, manufacturing, and energy usage. This is why one spending report can create a very different reaction across the markets. Okay, strong spending can lift equities but strengthen US dollar at the same time. Weak spending can hurt equities, but also weaken the US dollar if rate cuts get priced aggressively. And oil can move in the opposite direction if demand expectations shift faster than financial conditions. So when traders see spending data, they shouldn't ask, um, Is this good or bad? They should ask which channel is the market prioritizing right now? Growth? Is it growth? Is it policy? Is it demand? Okay, that answer determines how price moves. So, yeah, let's move on to the next part, which is US dollar and spending, growth, support, and rate cut signal. Oops. Okay, so the relationship between consumer spending and the US dollar is one of the most misunderstood dynamics in Forex. Many traders assume strong spending weakens the dollar. Give me a moment, guys. Hey, sorry, my mouse disconnected. Okay. Um, Okay, so where was I? Yeah, so many traders they assume that the US dollar, a strong spending weakens the dollar because it encourages risk taking, while spending strengthens it. Okay, in reality, it's far more nuanced. Okay, when spending is strong, especially in the US, okay, markets often push back expectations for rate cuts. Yields stay elevated, real rates remain attractive, and capital continues flowing into US dollar assets. In this scenario, strong spending actually supports the US dollar. Okay, even as equities rally. This is why you sometimes see the US dollar and stocks rising together, not because the market is confused, but because growth resilience keeps policy tight. On the other hand, when spending data weakens meaningfully, the US dollar reaction depends on context. If weak spending signals an upcoming slowdown and forces the Fed towards cuts. The US dollar can weaken as yields differentials compress, but if weak spending triggers global risk aversion, the US dollar can strengthen due to safe haven demand. So US dollar doesn't trade spending in isolation. It trades what spending implies for relative growth and policy. Is this Okay, is the US still performing? Are the economies outperforming other economies? Are rate cuts being delayed or pulled forward? Those questions matter more than the spending numbers itself. So for intraday and swing traders, like myself, actually, this is very crucial. Don't assume spending data has a fixed US dollar reaction. Always ask, is this data changing rate expectations or just confirming what's already priced in? That's what determines follow through. Okay, so I put a table here. Okay, this was taken 2 years ago. I mean, a year ago. Um, the US inflation and interest rates, the benchmark interest rate and year-on-year change on CPI inflation. So you can see that the red is the CPI, blue is core CPI, and the white is the benchmark interest rate. Okay, and inflation target is always kept low. Um, yeah, yes, they do move in tandem. Okay, let's move on to equities and oil and earnings reality versus uh, physical demand. Okay, so when it comes to equities, spending data is almost directly translated into earnings expectations. Strong consumer spending supports revenue growth, especially for consumer discretionary services and travel-related sectors. That's why equity indices often react positively to solid retail sales, even when inflation is sticky, because earnings visibility improves. But there's a second layer, margins. If spending is strong but costs are rising faster, equity reactions can be muted. This is why, as much expected, markets are constantly balancing revenue growth against cost pressure. Oil, however, plays by a different rule book. Okay, oil doesn't care about valuations or multiples. Okay, it cares about physical demand. Okay, travel, shipping, commuting, industrial activity, and freight all fit into oil consumption. Strong spending usually implies strong energy demand, which supports oil prices, and weak spending, especially in transport of or services, quickly feeds into softer oil demand expectations. What's interesting is when equities and oil diverge, you might see equities rally on rate cuts, hopes, while oil struggles because demand is actually slowing. Or oil might spike on supply constraints while equities stay flat because consumer spending is weakening. These divergences are extremely informative. They tell you whether markets are trading financial conditions or real economic activity. So for traders, this creates opportunity. When equities are pricing optimism, but oil is pricing demand stress, something eventually has to give. Okay, spending data often it acts like a tiebreaker actually, okay, that resolves those divergences. That's why professional traders never look at spending data in isolation. They watch how the US dollar, equities, and oil responds together or fail to respond together. Okay, we're going into our last subtopic for today, and then we're gonna do like a 10 minutes Q&A session. I mean, depending on time, obviously. We've got 20 minutes left. I should be able to finish up this last section in 10 minutes, and then we've got a good 10 minutes for Q&A. So if you guys have your questions ready, you guys have anything to ask me, you can start dropping it into the chat box. Once I'm done with this segment or this last subtopic, we'll go into a Q&A session. I'll start answering your questions. I know you guys usually have a lot of questions for me. I'm not even talking about the Vantage app. I'm even talking about Zoom alone. You guys usually have a lot of questions for me. So yeah, get your questions ready, and then you can start typing in the chat box or the Q&A box, and then we can do that Q&A session in a bit. Okay, so let's go into our last part, which is what to watch during earnings and data season. Okay. Let's start with why earnings and data seasons are about narrative shifts and not numbers. Okay, first off, okay, let's understand what earnings season or data season even mean. So earnings season is a time at the end of every quarter during which most public companies publish their earning numbers. Generally, they are four earning seasons, one each at quarter end. Okay, that's makes sense. Every quarter, they come up with their numbers. Okay, so The working, generally there is no official date or time to start of earnings season. Usually, an earning season starts 2 to 3 weeks after the end of a fiscal quarter. Okay. Usually, companies reveal their earnings to press first. After the press release, it files earning papers with the SEC via official forms, including FinStats. Okay, what I want to tell you guys is whatever I'm sharing with you guys is a lot to do with the US. Okay, I'm not talking about how every country operates, but this is how the US operates. A lot of our webinar, by the way, focuses a lot on US. Why? Because um because US is the most traded currency out there, so therefore it's only natural for me to focus on it. But I mean, once in a while, we can go into like other currencies or other countries if you guys want to. Just let me know in chat box. So what's important to remember? To investors, earnings season is important for short-term and long-term investors as they wish to take positions before and after the press release. For media outlets, earnings season is also a busy time for the financial news media. These outlets, such as CNBC, cover the earning release of major companies. Okay. Okay, so the point here, I mean, for all investors, select company or stocks, do research and decide on trade strategy, take positions and learn from each season. Okay, but one thing is one of the biggest misconceptions traders have is thinking earning seasons and data seasons are about individual beats and misses. Okay, in reality, markets don't care nearly as much about what already happened as they do about what companies and data are implying about the future. So earning and data season are really about narrative shifts, moments when the markets collectively updates its story about growth, demand, margins, and policy. During these periods, information doesn't arrive in isolation. Data comes in clusters. Retail sales, inflation, employment, earning calls, forward guidance, revisions. Okay, each release adds a piece to the puzzle. A single strong earnings report can be ignored. Okay, a series of companies talking about slowing demand or cautious consumers changes how markets price the entire economy. This is why you'll sometimes see markets sell off even when earnings beat expectations. If guidance turns cautious, if companies talk about weaker order books, or if consumers are described as trading down, markets reprice quickly. The same applies to economic data. One weak report doesn't matter, a pattern does. Okay, it has to be a series of events. Okay, so for traders, the skill during earnings and data season is not reacting to headlines, it's recognizing when the narrative is changing. Are companies still feeling confident? Are consumers still spending? Are margins still holding up? Once the narrative shifts, price action follows, often violently and faster than people expect it to. Okay, so let's look at the key signals to watch, guidance, margins, and consumer language. Okay, this is stages of how consumer behaves. I just put that there as a reference so that you guys can read it through. But if you want to extract real trading signals from early uh warning earnings seasons, you need to stop focusing on EPS beats and start listening to what management is actually saying. Forward guidance is far more important than last quarter's results. Okay, companies can beat earnings because of cost cutting, accounting timing, or one-off factors, but guidance tells you how confident they are about future demand. Margins are another crucial signal. When margins hold up despite inflation and higher rates, it tells markets that companies still have pricing power and consumers are absorbing higher costs. That's supportive for equities and growth expectations. But when margins compress, even with decent revenue growth, it suggests that costs are catching up and profitability is under pressure. Okay, that's when markets start getting nervous. One of the most underappreciated indicators during earnings season is language about the consumer. Phrases like trading down, more price sensitive, delayed purchases, or selective spending may sound subtle, but when they show up repeatedly across sectors, markets take notice. That's often the earliest warning sign that consumer momentum is weakening long before retail sales collapse. So for Forex and macro traders, this matters because corporate commentary often confirms or contradicts economic data. If data looks strong, but earnings calls sound cautious, markets usually trust the corporate reality more. Companies are closer to the ground than economists. That's why earnings season can quietly reshape macro expectations without dramatic headlines. Okay, so how traders position during earnings and data cluster. Um, so let me look at this. Okay, so from a trading perspective, earnings and data seasons are periods of reassessment, not trend chasing. Volatility often increases because markets are constantly updating expectations, testing assumptions, and repricing risk. This is when core relations across assets tend to tighten. Equities move together, Forex reacts more to macro themes, and commodities follow demand signals more closely. Okay, so professional traders approach these periods with patience. They reduce position size, wait for confirmation, and avoid overreacting to single releases. The best trades often come after the market digests multiple data points and clearer narrative emerges. That's when trends become more durable and less headline driven. Another key adjustment during these seasons is flexibility. Traders need to be willing to flip bias if the story changes. If the consumer looks resilient one week and fragile the next, clinging to an old narrative is costly. Markets don't reward conviction during uncertainty. They reward adaptability. Okay, so the biggest mistake retail traders make during earnings and data seasons is overtrading noise. Every headline feels urgent. Every candle looks tradable, but the real edge lies in stepping back and asking, what is the story becoming? Okay. Once that story is clear, whether it's resilient consumption, margin pressures, or slowing demand, price action becomes cleaner and opportunities become more asymmetric. Okay. So earnings and data season aren't about prediction. They're about listening, observing patterns, and positioning once the market tells you what the market's beliefs. Okay, traders who master this skill stop fighting volatility and start using it. Okay, so um yeah, guys, that is the end of our webinar for today. Thank you so much for sitting through the webinar. I do see some questions coming in already. Before we go into the Q&A session, I do want to remind you guys can follow Vantage on some of their social media handles, Facebook, Instagram, X, LinkedIn, and Telegram. You guys can just follow so that you get updates. You're in the loop of what's happening with Vantage and any promotions, any updates. It's good to just follow. I mean, it wouldn't hurt you anyways. Okay, so let's go into our Q&A session. We've got about 7 minutes left, right? I'm gonna pull out all the Q&A. Okay, give me a moment to pull out on Vantage app as well. Checking to see if there are any questions on Vantage app. Okay, it's just the chat is just moving. Yeah, the chat is just moving. So I'm going to leave Vantage app. I don't really see any recent questions on Vantage app, but the chat is moving quite a bit. Okay. I'm gonna answer those on Zoom. Okay, so hey Cass, if inflation is still high, uh, why are consumers still spending? Should we continue spending? Okay, first of all, yes, you definitely should be con within your means, right? I'm not asking you to spend money you don't have. Within your means, spend because it does support the economy, but also don't spend unnecessarily. Spend because you need it, makes you happy or whatever it is. Okay. So why are people still spending even though inflation is currently very high? Okay, because spending decisions lack inflation. People don't suddenly change behavior overnight. Okay, you've seen people been spending their whole life. Overconsumption is crazy. I personally don't overconsume, but um it's hard to ask someone who is over consuming to stop consuming, right? So as long as jobs are stable and wages are rising, consumers keep spending, and even if prices feel uncomfortable, the slowdown usually comes later and not immediately. So yeah, that's why people are still spending. Which is more important, the consumer confidence or the retail sales? Confident would lead, honestly. Retail sales, it's kind of like confirmation. So confidence tells you what might happen, and retail sales tell you what is happening. So when both move in the same direction, markets take it seriously. Okay. In the moment I see the chart moving. Okay. Which is yeah, I already answered that one. Why does strong consumer data sometimes slow down equities? Why does strong consumer data sometimes slow down? You mean, okay, I think why does strong consumer data hurt equities? Okay, because strong, that's a very good question. Okay, because strong spending can delay rate cuts. Okay, I think I mentioned this earlier on. If the market is positioned for easing and the consumer stays resilient, yields stay high and equities can sell off even on good data, for example. Okay. How do you know when consumers are finally cracking? How do you know when consumers are finally cracking? They will be signs, okay, for sure. Okay, it usually shows up in language before the numbers. Companies talking about um weaker foot traffic, or companies talking about trading down, delayed purchases. Okay, the hard data will come later, but definitely there's going to be signs. How do we see the signs as normal people? Okay, I guess a lot of this information is in the news, but I mean, you always have to take the news with a pinch of salt. Yeah, I know. Okay, that's a very good question. How do you know when the companies are doing whatever, right? You cannot know unless you are an insider. There's really no way to know. Your best bet is like the news, right? It's always the news because unless you have someone working inside those companies, it's really hard to find out until official data and whatever is released. Okay, so if you guys have any more questions, just ask in the chat box. Okay, I've got one more question here. Big picture, what should traders watch to understand the consumer right now? Um, Jobs, wages, confident trends, company commentary. I guess you can follow company releases. Not just one data release, obviously. One data release, again, like will not really move the market that much. Okay, it can move the market like short term. We're talking about spikes and like quick reactions, but not really, it's not really pricing in the market. Okay. Uh, I think the pattern matters a lot. Yeah, I think the pattern matters a lot. Okay, so do you guys have any more questions? I'm gonna stay here for minutes to see if you guys have any more question. If not, I'm going to end today's webinar. Okay, I don't see any more questions coming in from you guys, so I'm going to end today's session. Thanks for tuning in, guys. I will catch you guys next year, same time next Tuesday, actually. I'm just trying to be funny. 6th of December, same time, 5 p.m. Singapore time. I will catch you guys then. It'll be another interesting topic. Yes, wishing you guys a happy new year as well and Merry Christmas a week ago, a few days ago. But yeah, happy new year. I hope this year was fruitful to you guys. For those who didn't have as great of a year as others, it's okay. Next year is going to be your year. Okay, so next year is gonna be a positive year. Okay. Yeah, so bye guys. Take care. I will see you guys um soon in a week. Okay, bye.